Well, you were one of only 4 students who actually got registered for NNI, so.
What do we do now that we are registered?
Well,
You're going to talk about that today?
I'm going to talk about it with all the people who didn't get registered because I couldn't,
Right.
I can't make the request until I get everybody registered. But yes, so there was nothing due today for that. Not for that.
This computer goes slow.
You can hear that. Okay. Hi, Carolee. Carolee is one of the 4 people who also got registered for NNI, so.
Can you hear me?
Yes, you're pretty soft,
Okay.
but yes. Let me turn up my volume.
So were we supposed to have gone through that first module and do a quiz already?
No, you were, well, technically yes, but because only 4 of the 10 students actually got registered for NNI, I never sent the email to NNI to request that they move you to where you're supposed to be. So there's nothing due today with regards to that. I'm going to spend a little bit of time at the beginning of class again, hopefully with some of the other folks who didn't get that, didn't get registered for some reason. And then next week, I basically moved that assignment back 1 week.
Okay, good. I thought I was already late.
No, you're good.
I have to put this in.
Yeah, if you want to, you can just leave that plugged in too. Here, actually, you know what? Let me plug it in from the back. That way it's got Anybody do anything fun over the weekend? No. Or nobody wants to say anything. They had so much fun they don't want to say anything.
Is it just 3 of us?
So far, yes, just the 3 of us. Whoops. What's that? Oh,
Well, I had a naming on Saturday, so
Wow,
Me and my sister and some cousins received a name Saturday. So
that's awesome.
yeah,
Cool.
Congratulations.
thank you. It was a lot of work preparing and stressing and nervous, and everything went well.
That's awesome. Good job.
How's it going, Marcus?
Good.
Right on. Hey, you were one of the folks who doesn't look like you got signed up with NNI yet. Did you?
Oh yeah, I was looking at that. I did. I went back in and I made another account,
Mm-hmm.
but then like I wasn't able to hear what you were saying. I was last week I was getting some really bad news, and I was like talking to somebody I'd rather not be talking to while I was in class. I had to. My apologies and all that stuff, but I wasn't able to get. Was there a password or something? And what course were we supposed to sign up for?
So I guess one question: did you use that link that was in on Canvas to go to the rebuilding site to register?
Yeah.
Okay. Interesting. Can you tell me what your username is? Because for some reason you're not showing up. As long as you use that link to sign up, you should show up in the same group, even if you're not where you're supposed to be. But I'm not showing you at all. So maybe if you just give me your username, I'll email that to them so they can put you in the module
Okay.
to be in.
It should be M. Joe.
Oh, really? Okay. All right.
Yeah. Let me go back in again. I went to a returning student. I just basically re-signed. What do I do? And I'm in. It says, "Welcome back, Marcus." It's under M. Joe.
Okay.
I use my Yahoo email account. So it's marcusjoe69@yahoo.com.
Okay. But the username you used to sign in was just mjoe?
Uh-huh.
Okay. Cool. Well, I will, that's all I need to know. I'll email them that, give them that information, and then they can move you into our group. I don't know why you're not showing up in our group, but
Okay.
they can fix that. So,
And that's to be able to take the quizzes, right?
well, let's be able to do the module, yeah, and the quizzes are part of the module. So, yeah, and no worries on not having completed the first quiz. I moved that assignment back a week because only 4 out of 10 people managed to actually get signed up and get into the group at least where they're supposed to be. I don't know what happened to everybody else, so I just wanted to check in with folks about that.
Okay.
So you'll get an email from either me or NNI this week when they get you to the place where you're supposed to be, and then you can start.
Okay.
So,
Cool.
right on.
Thanks.
All right. So I don't know where the 6 other folks are, but I'm going to go ahead and start. And as they come in, I will just, well, let's see. Oh, a few other people just came in real quickly then. Hey, Jessica, so you have a username already with NNI, is that right?
Yeah, I do.
And do you know what that is? Because you're not showing up in my group.
It's J Cladisby is all it is.
Okay. All right. So I'm going to email them and have them move you into the right groups, and then you can start doing the NNI thing again.
Okay.
And let's see, who else? Oh, Melissa, we got you in. Okay. And Melissa, you're good to go so far. I'm going to mute you though because you're deep in it. Try to mute you. That's, oh, no, that's Melissa, I believe. Oh, maybe not. No. Yeah, I think it is. There. Ah, there we go. Okay. Melissa, I just muted you because you were beeping at us. Hey, Austin, I'm checking in with everybody about the NNI registration process. Did you get registered for the NNI module through that link that we were using last week, or that's in week number 3?
Yeah, I was about to do that right now, but I'll do that soon.
Yeah, if you can do that, and then just email me the username that you use, because I need to get NNI to put you all together in the same group, and then we can move on. Okay. Cool. All right. Thank you. So tonight, basically, aside from clearing up all that NNI confusion, we're going to be covering the financial statements again. This is sort of the last review chapter in finance in this class. And really, chapter 3 goes over financial statements again, as you should have covered them in financial accounting, but it does so in a little more depth. So you definitely, because you'll need to understand that as we go through this course and you start cranking numbers based on financial statements. So that's what we're going to do tonight. We're going to go through chapter 3 and go through the income statement, balance sheet, statement of cash flows, stockholders' equity, and then we're going to talk a little bit about taxes, income taxes, capital gains taxes, dividend taxes, things like that. And that will be what we cover out of chapter 3. And then next week, excuse me, next week I'm going to be out of town, but assuming that I have an internet connection at my hotel in Nez Perce, we're going over there to the our Nez Perce site next week for a board meeting. Every year, the Board of Trustees for the college goes to one site a year, and this year it's the Nez Perce site. So I'm going to be over there on Tuesday and Wednesday of next week, but I believe I will have an internet connection, and therefore we should have class. If for some reason, though, I'm not showing up on Zoom, check your email, because I will email. If I can't for some reason get connected to Zoom, I will at least send everybody an email letting you know that I can't, and to look for something else about chapter 4 next week. But I'm pretty certain I'll have enough internet access to do that next week. So. All right, so any questions before we sort of launch into chapter 3? Are financial statements anybody's favorite thing? I had one laugh from Candace. No? Raise their hand. You know, if financial statements become your favorite thing, you could be really good at finance job. Just saying. It's funny how if you get good, well, if you want to, if you get good at understanding like financial statements and these calculations and things like that, and you know how to work with calculating returns on money, they tend to pay you more for that. So just a little nugget there. All right, so I'm going to go through and talk about, and I'm going to use some of these visuals in chapter 3, some of the tables, to go through and talk about the different financial statements. And in publicly traded companies, so if you work for a company that sells stock, for instance, on one of the stock exchanges, there are actually regulations through the Securities and Exchange Commission, the SEC, that require publicly traded companies to report quarterly financial statements. So every 3 months, a publicly traded company will have to report financial statements, including an income statement, a balance sheet, statement of cash flows, a 10K, a bunch of other statements. And it's basically, the intent there is so that the publicly traded companies provide enough information to investors and to people who actually may want to buy their particular stock to make good decisions, to provide enough financial information on a regular basis to do that. And those financial statements are audited every year. And so, anybody know what an audit is or what the purpose of an audit is?
Isn't that when all of the transactions and all of the statements are basically reviewed? And it's like a process of almost like backtracking to make sure that the numbers match up and that, you know, funds weren't extracted into a place that it shouldn't have ended up. And, you know, there was no embezzlement. There was, well, what did you say earlier? There was no cook in the books kind of thing?
Yeah, well, that's one of the things that auditors definitely look for. All of those things sort of occur in an audit. And so auditors, the people who actually do the audit, are not employed by the company. They're employed by an outside accounting firm. They're all CPAs, certified public accountants. So they're masters of financial statements, financial statement superheroes, if you will. And they come in, and depending on the company. So every year the college gets audited once a year. Nonprofits, when they get to a certain size, they have to be audited every year too. And so the college does also. And the primary focus of most audits, of just your regular run-of-the-mill annual audit, is the auditors are trying to ensure that the financial statements that are produced by the organization accurately reflect what's going on, and that whatever supporting evidence and transactions and documentation the organization has to put those financial statements together is valid information. So yes, in that sense, to make sure that there isn't some discrepancy or somebody's manipulating the numbers. And so that's especially important for publicly traded companies, because investors and stock analysts and all sorts of other people rely on those publicly available financial statements to make decisions about whether or not they want to invest in a particular company. And so the auditor's job is pretty darn important. They don't work, they get paid by the company to do the audit, but they work for the public. And it's their job truly to ensure that for the public good, that these financial statements are reflected accurately. In a nonprofit situation like the college, the primary things that auditors look for are what they call personal inurement, which means running a nonprofit primarily for the benefit of one or more individuals. So actually somebody's, taking a large salary from a nonprofit. And so it's really not, nonprofits are put together and they have tax exempt status because they're supposed to be benefiting society or benefiting a community or benefiting some group of people. And if it's put together as a nonprofit, but really most of the funds, the revenues are going to pay salaries or pay contractors or things like that, then it comes into question why the nonprofit really is in existence. And so the auditors will check things like that for nonprofits. If the nonprofit received grants, especially from the federal government, the auditors also do some checking to ensure that the organization is following whatever the regulations of the grantor are, the person who gave them the money. So that's, and also just to ensure that they're not breaking any, say, labor laws. They're not paying overtime when it should be paid, or things like that. So But in the public setting, the auditor's main purpose or the main benefit of having audited financial statements is that you can rely on those financial statements to try to make decisions about whether or not you want to buy a stock from a particular company or buy a bond from a particular company or even go work for a particular company. A lot of employees, like executive employees, will actually sort of analyze the financial statements of a company to determine how stable that company is and whether or not they really, want to go work for them based on that stability or based on, other factors. And so there are all sorts of different individuals who, or groups of individuals who use financial statements to make decisions. So it's pretty important that they're accurate, and that's the auditor's job. And you can find these, you can actually find the financial statements of any publicly traded company. And I'll show you where, there's a number of different sites for this, but I'll show you one here that's pretty easy to access. If you just go to, I think it's finance.yahoo.com. And you can do a quote lookup here. So let's just look up MSN, which is, I think it's Microsoft. No, it's Emerson Radio Corp. See, that's what I know. So this is Emerson Radio Corporation. Let's find a better one than this, actually. Let's do Google. No, not Goog. See, I have to know the actual symbols of these particular, well, whoops. Let me try this one. I'm pretty sure that GE is GE. General Electric, so big company. You can see how big it is by looking at this number next to market cap. Market cap means market capitalization. That means how much is this company valued at based on the value of the stock in the marketplace. GE is valued at over $286 billion. So pretty big company. It shows, let's see, what else do you just get here? It shows, these are the market prices for the stock. Shows you the 52-week range. So this is a really basic gauge of where the stock has been trading in the last year. So it traded at a low of $19.37 up to a high of $32.05, which means it's pretty close to its high in the 52-week range. But you can also go down here to SEC filings. And if you click on that on the left-hand side, you get all of these filings. And 8Ks are the essentially the quarterly reports of the financial statements. And these guys actually put one out. Well, they have a bunch of updates here too, but you can just click on one of these. Let's see, results of operating. You can click on this. And are you going to give it to me? 1 second here. Full filing. Edgar Online is another great place to find this information. So all of this stuff, Form 8K section is the required filing. In section 9 are the financial statements and exhibits. So we should, and then down here some basic income statements and balance sheet. So you can click on the income statement, and it will show you the General Electric condensed statement of earnings. That just means it's not the fully classified statement. They made it simple to read. But you can pick up some good information from this. You can see that, and all these numbers are these are unaudited. So this is the other thing they'll show you. These aren't their annual papers because they're unaudited. They will have audited financials every year. But it shows you what their sales of goods are here. And I believe that this would be in billions, although I'm not seeing, usually they will tell you. I'm gonna move some folks here. We'll just assume that's millions. I know it's not millions. So in 2016, they had $25 billion in sales of goods and services. They have some other income there, that would be 9 million. And then it goes right into the costs and expenses here. Cost of sales are 20,362 million, 20,362 million. Selling, general and administrative, so G&A expenses and selling expenses total $4,608 million. Then you get your total costs here. And so they actually, in this particular period for 2016 so far, they actually are looking at a, let's see, 230 grand before income taxes, earning loss from, oh, I see, I'm not even at the bottom. Scroll down. They are actually showing a loss of, actually a gain of $69 million on sales of $25 billion in 2016. That's really not that good. If we do a little math here and we do 69, whoops, not 669, 69 divided by what was their revenue again? So I'm just doing a real basic gross profit calculation, which we're going to start doing next week. So we're taking their net income, which is 69, divided by their sales, which is 27,845. So they earned, this is the calculation here, 0.00247. Turn that into a percentage and move the decimal point to the right twice. So it's 0.247%. A quarter of a percent is what they earned from their operations during this period of time. So they're not doing super for whatever reason. You can go into, once you look at the financials, you can go in and look at some of these notes. They'll provide notes about maybe why the company wasn't doing so well. But all of this, all of the financial statements for publicly traded companies are publicly available to you and anyone else who wants to look at them. So if you're curious about any company that's traded on any public stock market, the NYSE, the NASDAQ in the United States, you can go to Edgar online, or you can go to finance.yahoo.com, a number of different sites, and you can pull up their financials and look at them. And this is what financial analysts do, or part of what they do, is to analyze the financial statements of companies that they're covering, and then they make recommendations, investment recommendations, based on those financial statements and based on news and expectations about products in the future and things of that nature. So this is all just a lot of information you can gather. So enough of that. For some reason, my monitor disappears occasionally, so you have to bear with me. There we go. All right, so back to, so we'll look at some basic financial statements then to start out with, to prepare you to be able to analyze statements like that. Do this here. And this is all from chapter 3, starting with table 3.1. I'm going to start working here. Oops. And hopefully, again, this should be review for all of you. These financial statements were all covered in BU 8212, financial accounting, or financial accounting somewhere else if you took it there. So we'll start with the balance sheet, which is table 3.1 here. And what does the balance sheet tell me? What do I learn from the balance sheet? Jessica, what do I learn from the balance sheet? What does it tell me?
The balance sheet will tell you the assets if they equal to the earnings of the company.
Close. Assets, it does tell you assets. It also tells you the other two components, liabilities
Liabilities.
and
Yeah.
equity, right? So if you remember that really cool formula from financial accounting, assets equals liabilities plus owner's equity, this is the statement that will tell you whether or not that's true. It should always be true if you're seeing it in a financial statement, but this is, you can verify that here. And so the balance sheet will always start with assets at the top. Those are the things that the company owns. And they will typically divide assets into two different classes, current assets and fixed assets. Sometimes they're called, fixed assets are also called non-current assets. But basically, this classification is based on how quickly you can turn an asset into cash. So current assets are things or assets you can turn into cash pretty quickly. And just like what did we talk about last year or last class? We talked about the money market and the capital markets. That has a distinguishing point of 1 year. So do current assets and fixed assets or non-current assets. If you can expect to turn something into cash in less than a year, then it's a current asset. If it would take you longer than that to turn it into cash, then it's considered a fixed asset. And so typical current assets that you'll see most frequently, cash. Cash is cash, so it's already cash. Accounts receivable, which are just, it's credit that the company has extended to customers so that they can buy something that they expect to be paid back. And so accounts receivable is also current assets. And then inventory. So the inventory of all the products maybe that a company is selling is also considered a current asset. And then here, in this particular balance sheet, they're calling the non-current assets fixed assets. Either way, their terms are both correct. Fixed assets are typically things like plant and equipment. So buildings, property, equipment, things that you may be able to turn into cash in less than a year, but it's going to take you longer certainly than these top three here, the items listed under current assets. And so you start out with the assets on the top. These are in millions of dollars. So this company has $1 billion of current assets, $1 billion of net plant and equipment. And so you add those two together, your current and your fixed asset, and you have total assets of $2 billion. That's how many assets this company owns. So after assets, you go into liabilities and equity. And the second thing is always going to be liabilities. So liabilities are things that the company owes, needs to pay at some point in time. And just like assets, it's divided into current, and in this case, they call it long-term bonds. Sometimes it will be called non-current liabilities. So there's current liabilities and long-term liabilities. Same way to distinguish these two as assets. Are you going to have to pay it within a year, or do you pay it in a period longer than a year out? So our current liabilities here are accounts payable, which are just like bills that the company has to pay, utility bills, supplier bills, whatever, that they're expected to pay in less than a year. Accruals. So accruals are things like employee taxes that have been collected out of the employee's paycheck, but not yet remitted to the government, not yet given to the government. Accruals could also be employee labor that has occurred already but not been paid. So there are things that you would need to pay these within the next week, month, 3 months, certainly less than a year. And the other example here of current liabilities is notes payable. And a note payable is just the way to think about that. It's a loan, but it's a short-term loan. It's a loan that's due in less than a year. So these amounts here, over here, for current liabilities, are all things that the company would expect to need to pay for in the next year. and that totals $310 million in current liabilities. We're going to do some calculations starting next week in Chapter 4, where we compare current liabilities and current assets. And we'll do a ratio. We'll calculate the current ratio, which compares how many current assets you have to how many current liabilities. And really what that tells you is how able is the company to be able to pay its bills. Does it have enough assets, current assets, to turn into cash to pay these bills? Or does it have more bills right now that need to be paid in less than a year than it has current assets? And if that's the case, then there's an issue there. So those are current liabilities, and then there's long-term bonds, or this is one example, long-term bonds. And a long-term bond is a bond that has a maturity longer than a year out. So if a company sells a 3-year bond to investors, so investors are essentially loaning the company money for 3 years, and at the end of 3 years, the company has to pay back the principal and the additional interest on those bonds to their investors. So if it's anything greater than a year out, it's a long-term bond, or it's a long-term liability. There are also other long-term liabilities like a mortgage. If the company has a mortgage on a building that's longer than a year, and most mortgages are, then that would show up as a long-term liability also. Okay. So, and just for terminology's sake, I don't really like how they do this particular balance sheet because they mix terms here. They're using current liabilities, and then they talk about long-term bonds, and then they talk about total debt. In my mind, it should just be total liabilities. It means the same thing as total debt, but because they're mixing up the language here, it's a little confusing, or it could be a little confusing. But total debt really is just adding your long-term bonds to your current liabilities in this situation. It's considered total debt or total liabilities, same thing. There are a few different terms that are used. So it's helpful to be comfortable using a couple different terms for referring to liabilities and assets for that matter. Because depending on who put together the financial statement, they could be using 1, 2, or 3 different terms. So that's debt. They have $1,060 million in debt here as their total debt. And again, that's just adding long-term bonds to their current liabilities. And then the last part of the balance sheet for a publicly traded company is called common equity. In your financial accounting class, this may have been referred to as owner's equity. In a private business, if there are no stockholders and it's a partnership or there's a single owner, then this section would be referred to as owner's equity, but it's the same thing really. But in a publicly traded company, you have to take a couple things into account. One of them is common stock. So a publicly traded company has stock out there. And so there's a value for the stock here, excuse me. And this value here, this 130, it says that there are 50 million shares out there, and that those shares are valued at 130 million. Seems a little low, right? So the thing is, with this particular number here, the 130, that's the value that the company originally sold the stock at. So it's not the market value of the stock today. It's what the stock was originally sold at. So that's just one thing to be aware of when we're looking at these numbers on a balance sheet. So that's one part of the equity of the company. The other part are called retained earnings. And retained earnings essentially are, I think the best way to explain it would be, so if you're in a business and your business earns, a publicly traded business, and your business earns $1 million in a year as profit, that's the net income at the end of the year. So the business may decide to distribute some of that $1 million to shareholders in the form of dividends. And really a dividend is just a payment to someone who owns a share of stock in a company to reflect the fact that the company was profitable. So it's a way of distributing profits to shareholders directly. And so if you own one share of stock, let's say in that case, they decided they were going to distribute half of that, so $500,000 back to shareholders in the form of dividends. If there were 500,000 shares out there, to make it simple, then every person who, or every shareholder, every share would receive $1 in dividend payment. So you get a check if you own 100 shares of this company and they were paying dividends at $1 a share, you get a check from the company for $100. So that's one way that the company can distribute profits to shareholders. Of course, the other way that shareholders make money is by the stock price rising. So there are two primary ways to do that. But the money that wasn't distributed back out to shareholders in the form of dividends is retained by the company to maybe purchase new equipment or to buy a new plant or to maybe just make their cash position better. And so that's what retained earnings are. It's the earnings that a company has had that haven't been distributed out to shareholders. Okay. Does anybody have a question? Okay, thought I heard something. So the sum of these two things, if you add these two things up, the common stock and retained earnings, that's what the total common equity is. That's equivalent to the owner's equity in the business. It's like if you took your assets of $2 billion and you subtracted your liabilities of $1.06 billion, that's what you would be left with, your total common equity. So if this business was just liquidated and everything else remained the same, according to this balance sheet, then the owners of the business would walk away with $940 billion shareholders to distribute. And so this is the balance sheet. And the two numbers, again, that have to be equal are the total assets, $2 billion, and the total liabilities and equity down here, which is also listed as $2 billion. Okay, any questions about that? And that's the brief explanation of the balance sheet, maybe not so brief. I muted you, Marcus. I hope you're all right. That sounded painful.
I don't think that was me, was it?
Oh, I don't know. I just muted you and it stopped.
Oh, okay.
It's hard to tell when I'm sharing my screen because I only see pictures of 4 of you right now. All right, so no balance sheet questions? Okay. Again, we're reviewing these so you're familiar with them so that starting next week in Chapter 4, we're going to start cranking out some ratios using all of these financial statements. So, okay. So moving on, we're going to move on to Table 3.2. Right, 3.2, yes. And so 3.2 is a basic income statement. This is sort of the equivalent of that consolidated income statement that we looked at. And you'll notice a lot of times when these, especially for public companies, when financial statements are reported, they're reported with the current year and then with the previous year. And that's really just to allow users of the financial statements to easily compare the performance between 2 years, between this year and the previous year. So income statement is pretty, oh, and one other, just a reminder about balance sheets. These numbers here are only true on one particular day. When whatever day that balance sheet was done, that's the only day that they're true. The next day, as soon as that company has some financial transactions, those numbers will change slightly. And so just keep in mind that balance sheets aren't for a period of time, they're just for one point in time. And so typically they're done at the end of a fiscal year. So I would imagine that for Allied Food Products here in 2011, assuming they're on the calendar fiscal year, their year ends in December, that this balance sheet would be accurate on December 31st of 2011.
So that's sort of like the reconciliation thing of the year.
What do you mean?
I don't know, because you have to reconcile and make sure you know where everything's at.
Oh, right. Yeah. To be able to produce this, but really any of the financial statements, you do have to reconcile. Yes. Yeah. The accounts. And so this would be what could be produced after you reconcile the books. Okay. So the balance sheet is, as far as the time period goes, is different than the income statement. The income statement is for a period of time. Typically, it's for a year. We'll be dealing with, most of the examples you'll be dealing with are for income statements that have a duration of 1 year. But again, for some public companies, they will publish their income statements every quarter or every 3 months. And so it just depends on the company and the purpose of the income statement, what the period of time will be. So the income statement here, very basic, just starting with sales or revenues. Sales and revenues are the same thing. It's what you sold during the year, whether you're selling products or services. It is the amount that you sold during that year. And so in this case, this is a real simple example because they have net sales up here at $3 billion. And then they move right to operating costs, except depreciation and amortization of $2,616,000,000. And so typically you'll have a breakdown where you have net sales. You might even have sales, and then you might have minus sales allowances equals net sales, and go from there. In fact, let me show you a quick example of what you should expect here. 15. Let's see, income statement. Here we go. So this is an example income statement that was used a few quarters ago. And so this has a few additional entries on it. And actually, I'm going to use this as an example because this works better than table 3-2. But just like that example, we have revenues or sales at the top. In this case, we have sales, and then we have sales returns and allowances. Sales returns and allowances are just things that were people returned products or were given discounts on services based on some factor. And so that's the amount of money that was either refunded to customers or discounted to customers, this negative 600,000 here. And that's subtracted off of your total sales to give you net sales. And this is important for the rest of the quarter here. Just know this, whenever there's a question that deals with sales, like if I want you to compute the gross profit of a company, which is net income divided by sales. If I just say sales and you are given this here, I want net sales, because net sales is always the most accurate because it's basically what the company really took in sales. It removes the $600,000 in this case that the company had to return to customers. So if there's any question that involves a sales calculation and you have the option of using net sales, use net sales. Yes, yeah, it's actual. It's the most accurate. Sometimes companies like to keep this number out there just so they know approximately what their sales returns and allowances are. But this is really what the company brought in the end, this $30,850,000. So then we have cost of goods sold, which is basically just the cost of what those items that were sold are. And then we have a gross profit here. And that's just the difference of net sales minus cost of goods sold give you gross profit. So that's the amount of profit that the company has before they recognize any other expenses except for the cost of the goods, whatever the goods are. So it doesn't reflect any labor, marketing, it reflects like if it's a car, manufacturer. Then it will reflect the labor on the assembly line, but it won't reflect any of the labor for like the administrative people or the sales people or anything like that. So they have $15.1 million as their gross profit, but then they have to pay their salespeople, and they have sales expenses of $2,875,000. They also have general and administrative expense, or G&A, which is basically all the support costs of a company, and salary. So accounting, HR would be in there. The executive would be in there. Maintenance, all of the costs and expenses associated with supporting making that car go in there, except the assembly line expenses. So then you take those two items out of your 15.1 million, and you're left with, or excuse me, in this case, we'll add them together to make our job easier. And then we take this number, 6,735,000, subtract it from our gross profit. That leaves us with this cool thing called EBITDA. Whoa.
Who's that now?
I don't know. I'm muting somebody's phone who just came on. Your phone number ends in 2041. So EBITDA is earnings. It stands for all these things: EBITDA, EBIT, and EBT. Earnings before interest, taxes, depreciation, and amortization. So that means that's what they've earned before they've taken out all those other things, before they've taken out interest expense, tax expense, depreciation, and amortization.
What's amortization?
Amortization is essentially when you have a loan, it is a portion. So you don't completely own the item if you have a loan on. Let's say it's a house, and so amortization is you're slowly paying off that house, right? Every month you put some to principal, and that's what amortization takes into account. Yeah. So this is your earnings before taking all those things out, and then typically what will happen, you'll have other expenses. So you'll slowly take those other expenses out until you get to net income, which is your sort of year-end walk-away figure, what you actually made.
But what do they use that EBITDA for?
It's just a way to calculate basically how efficient from just an operational standpoint a business is, without like the impact of how many loans it has or the taxes rates that it's going to be subject to. So it's sort of a measure of operational efficiency. Yeah, for internal use. Some yes, yeah, it's typically used by management. Some analysts like to look at that just as a way to, they'll calculate a ratio using EBITDA and net sales to determine how operationally efficient the company is. So I guess that's
a good one.
So from EBITDA, then we'll take out depreciation expense. So that's the expense of all of your fixed assets, your buildings and your vehicles slowly getting useless over the course of their lives. This is a non-cash expense. Depreciation expense isn't something you pay every year. It's just basically a loss of use. So as a building gets older and older, unless you maintain it, it's eventually going to be useless. And so this is just the accounting estimate of that loss of use. And so you subtract that from your $8,365,000, and you have EBIT now. And EBIT is earnings before interest and taxes. Okay. And then from that, you'll remove your interest expense, subtract that out, and then you have EBT, which is earnings before taxes. And then finally, you'll take taxes out, and that will leave your net income of $3,061,000. So this is the amount of money. This is the way that companies measure how profitable they are. If we wanted to calculate the net profit of this company, we divide $3,061,000 by their net sales, and that would tell us from a percentage how profitable. So let's just see.
Net income divided by net sales.
Net sales. So that gives us 0.099. I'm going to turn that into a percentage and add a couple decimal places. Here's another key here. So the net profit for this company is 9.92%. This is how profitable they were in comparison to their sales. So for every dollar of sales that they had, 9.92 cents was profit. Ended up coming back to them in the form of profit. This is another key for any calculations we do this quarter that are in percentage. Actually, for any calculations we do need to be done to 2 decimal places. So 9.92 is correct. 9.9 is not correct. 10 is definitely not correct. So make sure all of your answers when you do calculations this quarter from here on out are to 2 decimal places. Okay. I tend to have to reiterate that a few times throughout the quarter, and so I'll start earlier this time. Okay, so that's the basic explanation of the income statement. And again, we're going to be using this and these numbers in Chapter 4, starting Chapter 4 next week, just to calculate a bunch of different financial ratios. So any questions on that explanation of the income statement? No? You guys are good to go? Accounting
So
wizards?
is the income statement always going to be set in this kind of format?
Pretty similar. The ones that I provide as examples will follow this format, yes.
Okay, with these terms as well.
Yes.
Okay.
Yeah, I did. If you go out and look at some of these financial statements on Hoover's or wherever else, you'll see a number of different presentations of financial statements.
Yeah.
But yeah, I'm going to stick pretty much to the same format, so you get accustomed to. I'm more interested in you knowing what the terminology means and being able to calculate things based off of these than I am for you to read some esoteric financial statement.
Right on. Thanks.
Yep. All right. If there are no other questions about this or the balance sheet, I think it's time for our 10-minute mid-session break here. So
Yes.
let's take a break, come back at 6:07, and we'll talk about the statement of cash flows and statement of stockholders' equity.
Do you mute it while we're on break?
No, I can. Would you like me to?
Yeah.
Okay. Okay. Let's finish up with last two financial statements we're going to cover from chapter 3, and then talk a little bit about taxes. We'll be done. Hopefully be done a little early tonight. So we talked about income statements and balance sheets, and now we're going to talk about statement of cash flows. And this is probably, I would say, the most challenging and or complex financial statement we'll deal with, just because there's a lot going on. So I'm going to cover this in a little more detail, but I would definitely recommend that you go to page 69 in your book and review this after class in the next day or so, just so it sort of give yourself a chance to cement some of what you've heard in your mind. And I like this example a lot, table 3.3, because, oh, I guess I should share my screen too. That might help. There we go.
3.3 and page 69.
Yes. Because all these little letters here on the left, A through T, there are line-by-line explanations below that to tell you exactly what's going on for each of those particular items. So I'd recommend going through those and just looking at them so that you understand them. Some of the same things that you'll see in the income statement are reflected on a statement of cash flows. And like a statement of cash flows, like an income statement, a statement of cash flows is for a period of time. And so typically it's going to be for a year. So in this case, it's for 2011 for Allied Food Products. And really the bottom line, what a statement of cash flows will tell you is it will tell you whether or not you actually increased your cash position or decreased your cash position through the course of the year, through the course of operating. And you can't just tell that by an income statement, because some of the expenses that are on your income statement are non-cash, like depreciation expense. Even though it's subtracted off of your earnings on an income statement, it doesn't actually cost you any cash. It's just recognizing the fact that you're losing the use of some of those assets gradually. And so since you can't just use an income statement to sort of depict what's going on with your cash flows, you need another financial statement. And so that's what this is, the statement of cash flows. And so I'm going to quickly go through each of these lines here and explain what's going on and how they might affect cash flow for a business. And statement of cash flows are typically broken up into 4 sections. So they will be broken up into operating activities, long-term investing activities, financing activities, and then the last section is a summary, which summarizes the first 3 sections essentially. So the things in operating activities are things that cause cash to change based on you operating that business. Long-term investing activities, those are transactions like buying a building or buying a significant piece of equipment. Those are long-term investment activities that might affect your cash flow. And then the third section, financing activities, are you taking out loans to maybe purchase some of those long-term assets that you're purchasing in section 2 there? And if so, how many loans are you taking out? And so that would be a positive cash flow for loans, because you're actually getting money in based on securing a loan. And the other thing in financing activities you have to take account of is your payment of dividends to stockholders. Because if you're a profitable business and you decide you're going to pay out $1 a share or whatever to your stockholders, that's going to actually cost you in cash, even though it's not an expense on an income statement. You're just distributing some of the earnings, some of the net income from the business. But that has to be taken account of on a statement of cash flows. So, all right, so I'm just going to start from the top here, and everything sort of starts with the net income. whether or not you made money or lost money for a year. That's the basis from which you're going to add and subtract other things. And so you always start with net income. And this particular table is using, so this is another reason I like this, it's using the income statement from table 3.2 year 2011 for its numbers. And so you can, you can refer back to table 3.2 and see where these numbers are coming from in most cases. So, so first of all, we have net income, which is a positive. And again, or I should say, whenever you see numbers in brackets like this 200 in brackets, that means negative. For financial statements, you won't typically see a negative sign to reflect a negative number. You will see a number in brackets. And if it's in brackets, that means it's a negative number. In this case, it would be negative 200 million. So, all right, so we did net income, which is B. Depreciation and amortization, which is C, is listed as 100. And so that's the amount of depreciation and amortization expense that you recognized on your income statement. So if we go back here to 3.2, depreciation and amortization 100, right there. So that's the amount of depreciation expense that you took off on your income statement. But because it's not a cash expense, it's really a positive impact on cash flow, because in relation to the net income, your net income would have been $100 million higher if you wouldn't have taken that depreciation expense, right? And so you actually add this 100 back into your statement of cash flows. It's considered a positive cash flow. It was recognized as an expense, which is a negative, but it's not really a cash expense, so you have to add it back in. So we added $100 million in here. We have D, which is an increase in inventories, and that's listed as negative 200 million. And the reason that's listed as negative 200 million is because it's, and we would need to go back to the balance sheet to confirm this, which is table 3.1. If we look at our inventories from 2010 to 2011, they actually increased by $200 million. That's shown as an asset, but it's not a cash asset. It's locked up in inventory. And so we need to take that $200 million off of our statement of cash flows here, which is what happens here. So if you see an increase in inventories, you want to actually subtract that from your statement of cash flows. If you see a decrease in inventories, you'll actually want to increase your statement of cash flows. So, and again, this is sort of explained in detail in the notes below there, so highly recommend you reviewing these. E is an increase in accounts receivable. An increase in accounts receivable, just like inventories, is a negative impact on cash. That means that we have $60 million more in accounts receivable for our sales, which means we haven't received payment for them yet, but they are recognized as sales because we did sell them. We just sold them on credit. And so if our AR, if our accounts receivable increases, that would have a negative impact on our cash flows. Interrupt me as we're going through here. I'm just going to go down the list here if you have questions. We have an increase in accounts payable, and that's listed as a $30 million positive number. The reason that's positive is because we've increased our accounts payable, which means we bought additional things, but we have yet to pay for them. So there are $30 million more in bills or in items that we've secured, but we have yet to pay for them. So that's actually an increase during 2011 on our cash flow. It doesn't mean that we won't have to pay for them in the future, but it means that in 2011, we bought $30 million more on credit. And so that's actually a positive impact on our cash flow. Excuse me. And then G is increase in accrued wages and taxes. And again, these are wages and taxes that our employees have worked and maybe we've taken their federal taxes out of their paychecks, or we've deducted it from their paychecks, but we haven't yet either paid those wages to the employees and or paid the government for the taxes that we've owed. And because that accrued amount went up by $10 million in 2011, and again, we should be able to see that back on table 3.1, the accruals here. So our accruals in 2011 are 140. In 2010, they were 130, so that means they went up by 10 million. That means that's actually a positive impact on our cash flow in 2011. So we add 10 million to that. And then the last step here in operating activities is just to add all those things together. Add B through G together, and we get negative 2.5 million. So what that means is that just from our operating activities, these things that occurred in B through G, we actually have $2.5 million less in cash at the end of 2011 than we did at the start of 2011. All right. The second section here is long-term investing activities. And again, these are purchasing fixed assets, equipment, property, buildings, things of that nature. This is listed as negative 230. So if we go back to our balance sheet here, table 3.1, and we go to our fixed assets, net plant and equipment cost minus, this is actually listed only as 130. It's an increase of 130 million. I'm not sure. Let's see, 230. Oh, part of it was because we should have increased our long-term, because the company paid for some of that $230 million increase with a loan. So it wasn't actually, let me see here. And that would be part of long-term bonds there, but it doesn't break everything down because there's more than 100 million in there. So for this just means that the company essentially added $230 million of new property, plant, and equipment. But because you don't recognize all of that $230 million in expense during 2011, you depreciate it, so you recognize it. If you have a building, for instance, and it has a 30-year useful life, then you will take 1/30 of that expense every year for the next 30 years. That's how you write off a building. That's one way, straight line depreciation. And so even though they have 230 million in new buildings, they didn't necessarily expense that. That wasn't shown as an expense, all of that at least, on their income statement. So the rest of that, if it was still a cash expense, needs to be recognized. And so it's recognized here as negative 230 million. So more property, plant, and equipment means that's a negative impact on the cash flow. In this case, negative 230 million. Some of that's going to be offset by these things that happen in section 3. But that's the only thing there in section 2 was just the additions to property, plant, and equipment. And so if we go into section 3, which is this financing activities section, then we look at other things that occurred. We have increase in notes payable. So those are those short-term loans. They have $50 million more in short-term loans at the end of 2011 than they did at the start of 2011. So that's a positive impact on their cash. $50 million more in loans that they received. N, which is increase in bonds outstanding, is pretty much the same as increase in notes payable. You have more bonds outstanding at the end of the year than you do at the beginning, which means that you have received that much more cash during the year from selling those bonds. And so in this case, there was $170 million of additional bonds at the end of the year, and that had that positive impact on cash flow. And then the third item there under financing activities, payment of dividends to stockholders. So this was we go back here to our income statement. We can see that at the bottom here, it says total dividends. In 2011, they paid out $57.5 million in dividends to stockholders. And that has to be recognized on the cash flow statement as a negative, because that was money that the company was actually paying out to stockholders in the form of money, cash. So that's a negative impact. So you add those three things together and you get this net cash provided by financing activities. It's a positive $162.5 million. Okay. So those are the three sections of the statement of cash flows. And then this last section is just a summary of what we've just done. So R is just adding up the totals from sections 1, 2, and 3. Negative 2.5 million, negative 230 million, positive 162.5 million. When you add those three things up, you come up with negative $70 million. So over the course of 2011, this company's cash position decreased by $70 million. It went down by 70 million. But if you want to figure out where they are at the end of the year, you have to start out with where they were at the beginning of the year. So this section S here, or this letter S, cash and equivalents at the beginning of the year, 80 million. That's what they had at the beginning of the year. And if we go back up to our balance sheet, it should say, yes. So this is the end of 2010. They had 80 million in cash. At the end of 2011, they have 10. Why is that? Because they had negative $70 million in cash flow during the year. And so at the end of the year, yes, in fact, they just have 10 million in cash. So in almost every scenario, this is not, at least from a cash flow perspective, this is not a good thing. You went from 80 million at the beginning of the year to 10 million at the end of the year. You're going to have to be pretty careful in 2012 here. Okay, any questions about that? Any of those sections of the cash flow statement or any of those impacts from activities and why they work that way?
Is that common for most businesses to start at the beginning of a year with a larger sum and end with a smaller one like that?
No, I would say no, because if that occurs, obviously year after year, you're going to have you're not going to have any cash left at the end of the year. And so, no, at the least, you probably want to maintain whatever your cash level was at the beginning of the year, if not increase it. It's not always good to increase your cash flow, but because maybe it means that you're not paying enough dividends to your investors or something like that. But yeah, a decreasing cash flow throughout the course of the year is almost never good.
Okay.
Yeah.
The only way it would be not good is if you weren't paying dividends to stockholders or something like that.
Yeah, that's just an example of, you know, if the company was hoarding cash for no apparent reason, then investors usually don't. If the investors aren't benefiting from that, then they tend to get a little cranky. So yeah.
Right.
Yeah.
Okay.
There are
Would that have anything to do like with businesses that you wouldn't normally think of ever selling their stock, just all of a sudden, like over, you know, like the stockholders taking over the company and just selling it somewhere across seas or something like that?
You mean like a hostile takeover or something like that, where somebody comes in and tries to take control of a company by buying up a bunch of the stock?
I'm not exactly sure. Like for example, I don't know if you remember that company, FUBU, from like the 90s or something like that. It was a clothing company,
Right.
and like the letters were supposed to stand for us, by us, and it was like a company owned by like 4 African American men, and then that was their motto and stuff. And then 2 or 3 years later, they like sold it to a Japanese company.
Yeah, I guess the one example, I'm not sure of that about that particular example, so it's hard for me to sort of comment on how that might affect it,
Right.
or how cash position might affect that. But I do know that, for instance, one of the reasons that some companies hold a large portion of cash right now, for instance, Apple holds just literally billions of dollars in cash right now in Ireland, because they've created this Ireland subsidiary that all the sales of Apple products throughout the world go through, because Ireland has one of the lowest tax rates in the world. And so to avoid paying, say, United States corporate income taxes, they funnel all their sales through Ireland. But what that also means is that they can't repatriate those funds to the United States right now without having to pay those corporate income taxes. So Apple is sitting on a ton of cash right now, because they don't want to bring it back into the U.S., because then they'll have to pay corporate income taxes on that money. So that's one example of why a company might hold a lot of cash.
I see.
Yeah, there are other reasons, but you hear about that a lot these days. And it's not just Apple. There are many international companies that have foreign subsidiaries in countries that have very low tax rates, and they funnel as many activities through those countries as possible so that they can reduce their tax burden. Because in the end, if you're an investor, and we look at the income statement again, one of the things that comes out, and it could come out at 40% from that the company is taxed at, or are the company's taxes. So that can take a big bite into the earnings for what's leftovers for investors and owners of the company. Yeah.
So if they were across seas or whatever, and they had foreign bank accounts, okay, so I don't understand why that would be counterproductive for the company. Because couldn't you just pull funds from that foreign bank account? But you just said something about what did you say?
Repatriating those funds, yes.
Repatriating?
Right.
Okay, so does that does that have something to do with the currency, or?
Well, no, not really the currency, but what has to happen, because this in this case, this Apple subsidiary, it's a different company than Apple America.
Right.
Put it that way. And so to get funds back to Apple America, they have to distribute some of that money back in the form of profits.
Oh.
Yeah. And so if they were to do that, then that would have to be recognized by Apple America as profits and taxed at U.S. tax.
Oh, so then they could tax it.
Yeah.
Let's see. Okay.
Yeah.
So it's not like the majority of Apple employees or stockholders live in Ireland or anything like that. They're just like keeping those funds in holding for the most part.
Right. Yeah. And so investors in Apple don't really get any benefits at all from those funds being held offshore, because they're just sort of restricting, unless they own shares of Apple Ireland, then they would.
Oh,
right.
So that's what an offshore bank account means.
Well, yeah, there are all sorts of versions of that, and yeah, if you pay attention to what's been going on lately with these Panama Papers, you'll see all sorts of different schemes that wealthy individuals and companies use to essentially try to escape paying taxes in places that they live.
Panama Papers, huh?
Yeah. Yeah, look it up. It's pretty good. Pretty good reading. So, okay. Any other questions about the statement of cash flows? All right. One more short, I think. Oops, I have to go back here. Short financial statement. I'm going to go over a statement of stockholders' equity. And this was probably in financial accounting referred to as statement of owner's equity. Put my chair up there. And this essentially just shows what the owners of a company, what they hold in equity. And just like in the balance sheet, this shows retained earnings, and it also shows this common stock amount here. And so in the total of those two things, 130 plus 810, which are the retained earnings, is the total stockholders' equity. And a couple things just to note here. So it shows this first row is the balances at the end of the previous year, at the end of 2010. So there's $130 million common stock, original value. There's $750 million of retained earnings. That means at the end of last year, there was $880 million of total stockholders' equity, which if we go back to table 3.1 and go down to the bottom, $880 million in total equity. We're just adding those two together. However, through the course of operations during the year, the company earned this $117.5 million. So that's the net income. If you look at the net income statement or the income statement. But they distributed $57.5 million in dividends. So you add all these three things together, and you have retained earnings at the end of December 31st, 2011. Did I say that right? Yes, I did. And again, this gets us to total stockholders' equity here of $940 million, which is just 130 plus 810. So we're at 940 at the end of 2011. And they started the end of the previous year at 880 million. So it increased, retained earnings essentially increased by 60 million during the year. And all that is the difference between net income and the amount of that net income that they paid out to shareholders in the form of dividends. So that's an easy one. Any questions about statement of stockholders' equity?
So that total stockholders' equity is actually the amount and the retained earnings.
Is yes, the amount of
doesn't include the shares.
it does. The shares is the 130 is the value of those shares. So it's 130,
Okay.
yeah, plus 750 at the beginning. It was 880.
Okay.
So yeah, but this value again, because it's the initial value that the stock was sold at, it doesn't change year to year. So it will always remain 130 until they sell more shares. Maybe if they sell more shares, then that amount will change. So, okay. Any other questions about table 3.4 there?
Did any of these numbers come from the other tables?
Yes, yeah. So you can find the common stock amount on the on the balance sheet. You can find retained earnings on the balance sheet, and then the net income and the cash dividends amounts were from the income statement.
Yeah. All right.
Mm-hmm. Okay. No other questions about that? Okay, last thing we're going to talk about tonight is taxes, because we all hopefully just got finished done paying our taxes or getting a refund.
Well, can we go back over the other stuff?
Go over what other
I
stuff?
don't know.
Anything but taxes?
Yeah.
Candace doesn't want to talk about
3.5?
taxes right now.
Okay.
3.5, yes, table 3.5. We'll just start there. And this is just really I'm sure many of you already sort of understand this concept, but this is how taxes work in the United States. This is individual income taxes. So we'll start out talking about income taxes. So that's taxes on what you make. And it's called a graduated or progressive income tax schedule, because the more you make, the higher the percentage of tax that you pay up to a certain point. And so if you look here, and there are different tax tables based on whether you're single, whether you're married, filing joint returns, whether you're married, filing separately, whether you're head of household. There are a few different classifications. But they all work pretty much the same. They just have different numbers here in the amounts that you would pay. So we'll just use the single individuals portion as an example. So over here on the left is if your taxable income is this. So everybody gets a W-2 at the end of the year, assuming they're employed at a place that pays you money and you're not a contractor. And so the number in one of those boxes will tell you what your taxable income was for the year. So if you made less than $8,350, and this is from 2010, but these rates haven't changed significantly since then. If you made up to that amount, then you will pay 0 on the base of the bracket. So you'll start out paying 0, and then every dollar up to $83.50 you will pay 10%. So basically every dollar you earn, you'll pay 10 cents in taxes, income taxes on, until you hit $83.50. So if you made $10,000, you would still pay 10% on the first $8,350 that you made. But then from $8,350 to $10,000, you would pay 15 cents per dollar, or 15% on every dollar you made, until you get to the point of making more than $33,950, and then your tax bracket goes up again. And so here you see the progressive tax rates. It starts at a low of 10% and it goes up to 35%. So, and you need to make over $372,000 in a year to hit this top bracket here. My congratulations to you if you are in the top bracket. But the one thing to keep in mind is that these percentage here don't apply to the total amount. They just apply to the amount in this range. And so let's say I made $100,000, or somebody made $100,000. I certainly didn't. And so what would happen is you would be in this tax bracket. You would be in the 28% tax bracket. That does not mean, however, that you would pay 28% taxes. You would pay 10% on the first $83.50 that you made, and then $83.50 to $33,950, you'd pay 15%. And then once you got to $33,950 until $82,250, you'd pay 25% on every dollar. And then from $82,250 to $100,000, you would pay 28% on each dollar. So every time you go up in a tax bracket, you will pay the next higher rate, but only on the amount there after that tax rate. And so that's why you see over here the average tax rate at the top of the bracket is going to be lower, with the exception of the bottom and the bottom bracket and the top bracket here, for every bracket in between, because you may be in the 33% tax bracket, but you also have to take into account that you're only being taxed 28% for a while, and 25% for a while, and 15% for a while. So even if you're at the top of this 33% tax bracket, your effective tax rate is only 29% because of the impacts of these lower rates. So I'm not going to ask you, I'm not going to give you an amount and ask you to tell me what the amount of taxes that this person should pay. But what I do want you to understand is how this progressive tax table works, and to understand this one term here, which is important, marginal tax rate. And the marginal tax rate is the tax rate that you would pay on the last dollar that you earned of your income, or the highest dollar of your income. So in the case of any of these, being in any of these tax brackets, your marginal tax rate would be 33%. If you're in the last dollar that you earned in this tax bracket would be 33%. And so that's called a marginal tax rate. And the reason why that's important is because sometimes when people, especially people who make a lot of money, think about making a new investment or doing something that's going to earn them extra income, they think about it in the context of, well, if I add it to the income that I already had, how much of that am I going to keep? And so if you're already making $100,000 and you're in this 28% tax bracket, if you do something that causes you to make an extra $10,000, then your marginal tax rate is going to be 28%, and you're going to give the government 28% of that additional $10,000 that you make. So that's just one example of the way that sometimes people think about earning additional income. How much will they actually get to keep, which is how much they're not giving back to the government in some form. Okay, any questions about that tax table, marginal tax rate, the term, how these calculations work? You guys are so quiet, you scare me.
Well, everything looks fine while you're here. Once we get home and try to do it ourselves, it's gonna look
Everything
different.
is fine while I'm here?
Yeah.
Well, so here's one key. This is just the little learning key for you. If you can, review this information like tonight, or if you can't, review it by tomorrow, because one of the keys to learning is you need to reinforce what you've learned for the first time within 24 hours for it to have a reasonable chance of moving from short-term memory to long-term memory. So repetition and review is key. So if you're only like clicking on the video and watching me say the same thing again, that's still repetition. It's better to work with it and do some of the exercises, which you're going to get to do. But yeah, look
So
at it
that's your
again.
Psychology major sticking in.
Well, yeah, that's my experience with Brain Rules. This great
Okay.
book.
Okay.
So yeah, do it within 24 hours, and it'll be a lot easier to shove it into your long-term memory. All right, two last things here about taxes. And really, I just want you to know about these conceptually. So one is, we talked about income taxes. That's what these things are. But there are other types of taxes, especially if you have money and you're investing your money. And one of them is called a capital gains tax. And a capital gains tax is essentially a tax that you need to pay or should pay if you sell an item at a price that's higher than you bought the item at. And this could have to do with a car, a house. Usually it's like a share of stock or something like that. And that's called a capital gains tax because you're gaining, your capital is increasing in value, and the government wants some of that increase because it's technically income to you. Any increase in capital gains is going to be an income to you in the end. And so that's what these taxes are levied on. There are two types of capital gains tax, or two types of capital gains. There's a short-term gain and a long-term gain. And because people in the financial world are real simple, they just keep it all at that 1 year mark. A short-term gain is something that's occurred in the period of 1 year or shorter. So if you buy a stock and you sell it in less than a year, that's a short-term gain. If you buy a stock and you sell it in 2 years, that's considered a long-term gain. And the reason why that's important is because they're taxed differently. Short-term gains are taxed at the same rate of income as all of your other income. So those tax tables we just looked at, if you're in the 28% tax bracket and you have a short-term capital gain, it's going to be taxed at 28%. However, if it's a long-term gain and you hold it for longer than a year, those are taxed at a maximum rate of 15%. So there's some real incentive there for one, for you, well, there's all sorts of incentives for people not to be day traders. And let me discourage you from that. Even if you come out of this class feeling like you're a financial wizard, don't be a day trader. One, because you hit the short-term capital gains tax and you get taxed like crazy if you make money, if you don't lose your shirt, which is typically what happens. But if you hold on to that asset, whether it's a house, a car, any asset that you make a gain on, piece of artwork, or a stock or a bond, longer than a year, then you're going to max out your tax rate at 15%, which for most people is a good thing, because if they're investing money and they're earning any significant amount of money, typically their tax rate is already above 15% already. So that's a long-term gain. It's taxed at that rate. So that's capital gains tax. The other type of tax, the last type of tax I'm going to talk about, are taxes on dividends. They are taxed differently than either income or capital gains. And dividends are taxed also at 15%, which for most investors is a steal, or at least is a deal. It's not as high of a tax as they're paying on the rest of their income. And this was reduced in good old George W. Bush's era down to 15%. And the reason it was reduced is because the corporations, the C corporations that pay out dividends, they already are taxed. The companies themselves are taxed. They pay this corporate tax of 35%, let's say. So even before a company can hand out any dividends to its shareholders, 35% goes to the government. That's a corporate tax. And then once those shareholders paid a dividend, then the shareholders themselves have to pay a tax on that dividend that was paid out. And so that's, when you're an investor or a shareholder in a C corporation, you're essentially experiencing double taxation, because the corporation gets taxed once, and then after that amount of money comes out, then any distributions that are made to the shareholders in the form of dividends are taxed again, or at least they're taxed on the individual shareholders' income tax statement. So for a long time, it was those dividends were taxed at the regular personal income rate. But because C corporations have it so hard, and I'm being completely sarcastic when I say that, they decided to reduce the dividends, the tax rate on dividends, to 15%. So basically, capital gains tax and dividend taxes are good deals for investors, for people with a lot of money. And it's funny how our system tends to reward people with lots of money these days. Okay, but I'm not going to editorialize too much more. That is all I have. Any questions about dividends, tax rates, financial statements, anything of that nature? No? Okay, so for next week, I'm going to go back to my handy dandy canvas here, or try to at least. Few things. There's some problems from chapter 3, and so I need to reiterate this. And there's actually, I have a scan copy of these just to make it even easier. But at the end of every chapter, there are usually questions and problems. And for whatever reason, the publisher decided to number them the same way. So there's a question 3-1, and there's a problem 3-1 at the end of chapter 3. These are problems. So problems 3.3, 3.4, 3.7, and 3.10. Okay. These are challenging. The key to doing these, making it easier for you, is just to do, and this is great practice also, is to do a basic, if it's a question about an income statement, just do a very brief income statement with the information that it gives you. Because essentially what these questions are like fill in the blanks. If it's a question about what is the impact on a cash flow statement from dividends or something like that, they give you a bunch of other information that you can almost create a cash flow statement with that one, with the exception of that one piece of missing information. So because it's good practice and because it's the best way to solve these problems, I recommend that you just create a little financial statement, whether it's a balance sheet, income statement, or cash flow statement, whichever one the question applies to. And that will help you solve those problems much easier. So that's one assignment, those problems. I'm going to, let's see here. Anyone who has not yet registered for NNI, please do so and send me your username, because I need to get NNI to move y'all to the right place. And I will send them an email tomorrow to ask them to do that. So do that tonight, and then I will send them the information, and I will let you know, and they'll probably email you also once you're moved to that, the module you need to be, which is the nation-owned enterprise module. And then you can do that. And I just moved the work up to quiz 1 to next week. So you have another week to do it, since couldn't get it coordinated this last week. And then finally, read Chapter 4. Chapter 4 is the first dose of new financial calculations that we're going to be doing. So starting next week, we're going to start cranking some numbers based on financial statements, which is really why you need to know those well. Okay, any questions, comments? No? All right, if not, have a good week. And I will be in touch about NNI, or someone will be in touch about NNI for you. And then, yeah, we'll go from there. So email me if you have any problems with homework too. I'll be around. And then next week, again, if for some reason I don't appear in Zoom next Tuesday night at 5 or shortly thereafter, check your email, because I will be at another location that I'm assuming has internet access that I can teach from. But if for some reason I'm having technical issues, I will send y'all an email and let you know that. So, all right, have a good week. Enjoy the sun.
All right, thanks, Steve.
Yep.
I like that you do a PDF of the actual problems. Because that was the problem in a different textbook. It had questions and then it had problems.
Mm-hmm.
Yeah.
Probably in BUAD 235.
Yes.